Welcome back to the next segment of today, and moving quite swiftly on from global equities, we're moving to our global cautious fund managed by Perfect, and I'm very happy to have Stefan Bain join us for this morning's session. Stefan, thanks for joining us. I believe this is your debut.
It is, yes. I'm very happy to be here, and thank you for having me.
No, really appreciate it, and thanks for your time, and the audience become familiar with your face, I'm sure, through the quarters again. Stefan is Head of Portfolio Management on the Asia Pacific side at Perfect. Stefan, without further ado, let's talk about the numbers and how the fund has done from a performance point of view in the last quarter and recent history for that matter.
Okay, so just jumping into the numbers, which should be on your first slide there. And the numbers are referencing the full year, but actually the trends that we've seen over the year have been pretty much replicated over the last quarter also. So I'll just touch on those generally. So the performance over the year has been quite strong, up 5% overall, and that's been very much driven by a very strong performance for equities over that period, and we've seen that continue into the most recent quarter. Touching upon bond performance, these were up about 3%. We outperformed strongly on non-US bonds, and to a large degree that's because of the weakness in Japanese bonds. They're quite a big component of your index there, about a third of the index. US bonds also outperformed, but I guess the standout has been equity performance. US equities in particular had a strong period, up 26%, outperforming their index. And that's very much been the tech trade. The stocks that led that have been Intel, Alphabet, Amphenol, which makes connectors that go into data centers, and Texas Instruments, which is a analog chip maker. Asia was also strong, outperforming its index. The slight laggard on the non-US equities side has been Europe, which has been hurt by almost the other side of the AI trade, which is software names have been weak. The market's been worried that their business models may be impacted negatively by AI, and some of our software names in Europe have been weak over both periods of the full year and the sort of latest quarter.
Thanks, Stefan. Before we had you join, we spoke with our global managers on the bond side, on the equity and the emerging market equity side as well. And I think what your slide there presents is a nice intersection of all of these different asset classes and how they might interact with one another. One thing we didn't chat about too much in our previous sessions is Japan. And you touched on it briefly in your previous slide there around, the Japanese yen, the weakest against the dollar for some time. Yet relative to the United States, the Japanese government runs quite a solid balance sheet. I mean, in your view, is the yen sort of undervalued at these levels? And what is your opinion and view on that?
So yeah, the yen has been very noticeable in its weakness. It's been one of the weakest major currencies coming out of COVID. And I guess we can see on the slide there, it shows the trend for the US dollar to the Japanese yen in purple. And it's been quite a sharp weakening, maybe since 2012 when Abenomics took off from about 80 to 160. And as you say, that's almost the weakest rate in about 40 years. What I'm also showing on that chart in the green line is the difference between US interest rates and Japanese interest rates. And what I've got here is the 10-year differential. And for a long, long time, those two are very correlated. And that makes sense, obviously. If you see higher interest rates in one market, money would flow to that market. But what is interesting is since 2023, that relationship has completely broken down. And that's a period where Japanese interest rates have risen quite substantially. Now, this matters for your portfolio in that we are underweight yen assets and we don't have any Japanese bonds. So that was beneficial, as we discussed earlier in performance terms. But it also matters from a global perspective. What happens in Japan does impact global markets. It's a significant overseas investor. And that's what the next chart tries to show. It shows the net international position divided by GDP as a percentage of GDP. Japan has huge overseas assets. They're the biggest buyer of US bonds. They own about $1 trillion of US bonds and about $3 trillion of portfolio assets, $3 trillion. The flip side to that is the US market, which this chart shows. They're negative 80% of GDP. So essentially investors have been buying US assets and Japanese investors in particular. And this has been the trend we've seen for multiple years. Again, you can see that the change in the US net international position has gone from 20% of GDP to 80%. Now that makes sense, obviously, for Japanese investors because returns in Japan have been poor, but overseas returns will be much better. But what is a risk, I guess, is that we've seen yields in Japan pick up quite significantly, and there is a risk that some of that money that's flowed out of Japan gets repatriated. And that could be a significant driver of the yen dollar rate. So this is something we have to look at. And the question is, why is that happening? Why has there been this divergence in the yen versus interest rates? I would say that the biggest driver is that the sense that the BOJ is behind the curve. Markets can see the pressure in terms of inflation in Japan, but the BOJ is resistant to increase rates. At the same time, the government's embarking on a fiscal spending program, quite aggressive, and it's multi-year. So what we see is the yield curve steepening in Japan. And what that means is that yields at the longer end have risen much more than the shorter end. And that's because the BOJ is not moving, but the pressure to move is building. And there's a kind of feedback loop here in that when the yen weakens, input costs rise in Japan, and it's not helped by a high oil price at the moment. That drives up internal inflation, which puts more pressure on the BOJ to raise rates. So that's what we're seeing as a kind of, the market is looking at a contradiction in central bank policy, fiscal policy, given where we are in terms of the economy in Japan. It's actually quite tight, labor's tight, capital goods are tight. So there does seem to be a contradiction there. So something's going to have to give.
Thanks, Stefan. We're always seeking cohesion, but you're right, the world is full of contradictions. And I want to move across the pond from Japan, the Pacific pond, that is, not the Atlantic as we commonly use, the Pacific pond from Japan into the US. And you have a slide here on US corporate profits. Some investors will say we're in a structurally new environment where these large cap companies can actually sustain such large levels or permanently higher profit margins than they have historically. Do you agree with this view? And what is your take on that? And if so, does anything explain that shift?
Yeah, it's one of the key questions I think we have as investors. There's been a remarkable change in profitability in US corporate profits in particular. We show that on the chart here. The green line shows corporate profits as a percentage of gross national income. And that has increased consistently since the 1980s and is now at a record level. The flip side of that is that employee compensation is now at a record low. And that is a low compared to the 1950s. There's a lot of talk about the K-shaped economy. I don't know if you've heard that term, but there's a sense that people at the top are doing very, very well, and you get a certain segment of society is seeing growth, but lots of people at the bottom are facing pressure and are feeling a different direction. And you see this sort of K-shaped relationship all over the economic data that we look at. So your key question is, can this level of profit growth continue, and can the percentage of profits to GDP continue to grow? For that, you really have to ask, well, what has caused this growth rate in the first place? I would argue that one of the biggest drivers of this profit share to corporates has been the fiscal deficit. It's not a coincidence that the fiscal deficit in the US started to be consistent after the 1980s. Around 2000, there was a surplus, but then since then, we've seen sort of a rapid growth to a higher fiscal deficit and a consistently large fiscal deficit, which is now running about 6% of GDP. And that's unprecedented in a non-recessionary environment. One surplus or one deficit really equates to someone else's surplus. So if someone's spending, someone's receiving that income. And so having a large deficit flows through to the corporate sector, and it's a big driver, in my opinion, of that large profit margin. Is that sustainable? well, there's lots of debate about that. There is no sense that any party in the US is looking to reduce that deficit, but just to give you a sense of the magnitude, interest costs in the US are now at a similar level to defense spending. That alone would maybe question the sustainability. So I guess something's probably going to change there, and that will have an impact in margins. Some other drivers, there was a real change in profitability after COVID, a genuinely broad change in profitability. The Fed did a study on what was driving the profit share, and they found that it's traditional sectors like retail, wholesale, construction, manufacturing, healthcare. So there was a broad-based improvement, but that is now slowed, and the shift again, and we're going to hear the story repeatedly, is really now driven by the AI investment cycle. That is one of the largest drivers of US GDP at the moment. So again, there's been a shift from broad to narrow. And maybe the last driver of corporate profits is worth mentioning is the wealth effect. Again, AI related. Real consumption growth in the US is running well ahead of income. And that gap is either made up of taking out debt or asset wealth, depending on how lucky you are and where you sit in society. And essentially, that wealth impact has been driven by equity gains. 35% of household net worth is now equity wealth. That used to be 10% in the 1990s, and very much driven by technology names. So what I'm trying to say here is that a lot of factors have driven corporate profits, but the argument is, are they sustainable? Can this keep going? I think we're sitting on some narrow drivers that could easily reverse.
So on the notion of corporate profits, your next slide talks about the free cash flow, the 12-month free cash flow. Looking at your semiconductor companies and what you call is your hyperscalers. So your semiconductor companies like NVIDIA, Broadcom, and hyperscalers, familiar names like Amazon, Alphabet, Microsoft, etc. Bifurcation seems to be the word of the day, and this is what we're visually seeing here. The semiconductor free cash flow seems to have absolutely surged in stark contrast to what we're seeing from the hyperscalers. Where those returns look a little bit less certain, if that's the right word. Is that really what we're seeing here?
Yeah, I think so. I love this chart. Sometimes a simple chart just nails the problem straight away. And that shows it, which is a massive change in the free cash flow of what were big buyback drivers in the US market. And so by hyperscalers, I mean the companies who are building these data centers. That's Amazon, Microsoft, Meta, Oracle. They're spending huge amounts on new data centers, and that money is going somewhere, and it's going to the chip companies. And some of the chip companies are mentioned there, which tends to be the US ones on that chart. But to a large degree, that's also flowing to Asian chip companies. That's Samsung, SK Hynix, TSMC. There's been a huge wealth transfer from corporate US's buyback companies to Asian technology companies. And that's having a sort of global impact. And we really have to question whether that is a sustainable situation to have your free cash flow go negative. A recent UBS survey suggested that 57% of hyperscaler capex was now being spent on memory. That's DRAM and NAND. That used to be 7% in 2022. And this is benefiting Korean economies. For an example, if we look at Korea, the chip makers there have agreed with their employees to give 10% of operating profits to memory-related employees. That equates to $400,000 to $500,000 per employee. If you look at 2026 forecast, it's getting up to $700,000. That is amazing, but it's very narrow again. We're looking at maybe 0.5% of Korea's population are receiving a bonus pool of about 2% of GDP. And more recently, the central bank in Korea has increased interest rates because they're worried about the inflation risk of this wealth transfer. So we see that the investment boom in the US is petering out and having impacts all over global markets. But more and more markets are asking whether this is sustainable. And I think that the change is when free cash flow goes negative, hyperscalers are now issuing debt. They've issued about $170 billion of debt. in the last year. And just today, there was a Nikkei article looking at the off-balance sheet lease commitments that hyperscalers have made, and they've got an estimate of 1.65 trillion of off-balance sheet commitments, which is huge, and doesn't really become visible until those data centers start to operate. So something's coming down the line. So again, this is all about sustainability. I think we remain cautious that this sort of investment is sustainable, and I think more and more markets are asking, where's the return on investment here?
Thanks, Stefan. Apologies for the viewers. There's a bit of a scrambling in our video feed here, but we shall persevere because we only have, I guess, one more section from today. But just on that AI notion, I was reading about Uber blowing its AI budget for the entire year by May, which I guess speaks to corporate spending in this space. And the semiconductors, if they are benefiting from a profit point of view, maybe that kind of paints that picture of why that is happening. Corporates are eating through their tokens way faster than they envisioned and budgeted for that matter. Stefan, pulling it all together, what is your outlook? I know your penultimate slide here has 3 banners that you want to speak to, and then the final slide is just around how the portfolio might be positioned for that scenario.
So I've shown a few charts here, and they all look quite disparate charts and different, but they all tie into a common theme. And that is recent equity market strength, and to a degree macro strength, has relied upon quite narrow factors, very AI related, deficit related, and wealth effects that again are sort of tied into the AI boom. So we're concerned about the sustainability of those drivers. Overall, we don't think equity markets represent value in general at current levels, and are very susceptible to external shocks. We see Iran situation again is unresolved, pushing up oil prices, and that has an impact on markets in the short term. So that issue has not gone away either. Those higher input costs, whether it's oil or chip costs, are slowly pushing up rate expectations. But I would argue that rates are a very blunt instrument to try and either manage energy price inflation or AI investment, but it does impact everybody in the economy. And as we've tried to demonstrate, I think people are having a very different experience depending upon where you are in terms of having a boom or a cost of living crisis. So I think there is a difficulty with rates being the tool that can slow down, again, a very, very narrow experience in terms of investment. So we remain cautious. We're relatively short duration on bonds. We remain a low weighting to equity markets at this point.
Before we let you go, your final slide just does speak to the portfolio and the positioning. We've spoken about Japan to a fair degree. The Asia ex-Japan component has become increasingly material for reasons you've covered in terms of the AI sphere there. You've covered a fair amount in terms of the bonds. But is there anything else that you'd want the viewer to take away from this final slide?
Yeah, it's just to reiterate that cautious view flows through to our portfolio positioning. We do have a low weighting in equities at the moment, 20% of the portfolio. 8% is in the US equities, 12% overseas, and we tend to invest in more defensive markets. We have overweights in Australia, Hong Kong, Singapore. Bonds are still 80%, and again, we're quite conservative in a bond allocation. As I mentioned, low duration, big weights in Australian bonds and UK bonds, and that continues to be the positioning for the foreseeable future.
Wonderful. Thanks, Stefan. Well, as you usher in a new leadership team there, hopefully the UK bonds don't respond like they did during the Trust week-long administration. But yeah, thanks very much for your time today and for your debut with us. We really appreciate your thoughts and your feedback on the fund. And we'll catch up either with you or your colleague in a quarter's time.
Perfect. Thank you very much.
Cheers, Stefan. Take care.